I'd like to ask unanimous consent to insert a member into the record.
The record. There is no objection.
All right, thank you. This is going to be an easier job than I thought working with you. All right. Along those veins, Mr. Golden, the final House and Senate fiscal year 2020 FSGG appropriations agreement included bipartisan report language requiring a new study outlining any potential negative impacts of CECL accounting standards on consumer credit and the economy to be completed and reported back to Congress in 2020. Given this development, and maybe this falls in line with something that the chairman was going after, don't you agree it would be prudent to impose a moratorium of some sort on the implementation of CECL until Congress has a better understanding of the negative impacts, and frankly, you all have a better understanding of the negative impacts on consumer credit? And doesn't FASB support a thorough assessment of the impacts of those standards on consumers and the economy and various communities affected?
The report in the appropriations talks about understanding the impact of regulatory capital that comes from CECL. We believe that CECL improves the information to our capital markets.
I understand that. We've gone over that.
Yeah.
What I'm asking is, don't you believe that you should have this study done and have those results before it is actually implemented?
We don't. We believe CECL should be implemented, and we believe the data that will come from implementation will help improve the study.
And you still intend to do the study?
The study, I think, is done by the U.S. Treasury Department.
By who?
I guess if you could clarify that, who's actually doing the study?
I thought you directed Treasury to do the study.
Okay. Well, I'll allow my colleague to take her time to ask that. In an effort, Mr. Duhnke, to not let you feel left out of this hearing, I have a suspicion that there will be a number of things that will continue to be discussed regarding the FASB situation. We've been talking about PCAOB examinations and enforcement a bit at the hearing. The chairman brought that up. Is that what you would consider to be the core role of the PCAOB?
Yeah, the core functions of the PCAOB are inspections, enforcement, and standard setting. I would argue
Okay.
even it's reflected in our structure. Our biggest part is our inspections.
All right. And am I correct in understanding that the SEC has oversight not only of your agency, but also any specific enforcement action that the PCAOB undertakes?
They are involved as an appellate authority, yes.
Okay. And as I understand it, the SEC itself has an examinations program and an enforcement arm. Is that correct?
They do.
Okay. Would you say that the SEC's program and setup in regard is similar to that of the PCAOB, except that your organization only examines accountants?
If we examine audits, yes, it's similar.
The audits, okay.
Yep.
So I guess I'm asking these questions because I'm wondering if we are not seeing a duplication and some overlap between the PCAOB and the SEC, as not to mention that redundancy on that side, but also I think we have a responsibility to ask what are those additional costs that are put on onto public companies and broker-dealers, and if we could reduce those costs. I mean, this committee has talked about IPOs and the challenges that we've had in growing this economy and making sure that it's not just unicorn companies. By the way, if there's a herd of them, I don't think we can no longer call them unicorns. But at some point, we need to have a robust growth within our public sector company area. And you know, when this committee was considering the PCAOB whistleblower legislation, there was not a single person here opposed to whistleblowers and having them have the ability to go and expose wrongdoing. But I was opposed to creating a redundant whistleblower program, given the existence of the SEC whistleblower office that was created under Dodd-Frank. So additionally, the added costs associated with setting up new whistleblower program only forced PCAOB to divert precious resources from other projects in order to get this duplicative program off the ground. So that's sort of the thinking what I'm puzzling about and what I'm trying to look at, and is if we have the courage to have a good hard examination of Sarbanes-Oxley and a number of the other things that are interconnected into this, I want to make sure that your work is not duplicative, and that those that you're regulating aren't getting cross answers, that they're not getting two different sets of enforcement. It may not be intentionally, but I know I'm a little over. I know the chairman had gone a little bit over. Maybe if you could just wrap up and address that quickly.
The short answer to your question is there are a number of similarities and redundancies between the PCAOB's mission and the SEC's, just by the nature of its setup. It's unavoidable.
Okay. Well, with that, my time has expired, and I appreciate it.
It's my understanding the gentleman from Connecticut would like me to skip him and go on to the gentlelady from Iowa, who's recognized for 5 minutes.
Thank you, Chairman Sherman, and congratulations, by the way. Thank you so much for our witnesses for being here today. Very much appreciate it. Chairman Golden, I have a couple of questions for you about tax disclosures. Thanks to OECD and other agreements, tax authorities throughout the world are now collecting and exchanging reports from multinational corporations with information about their operations on a country-by-country basis. Despite that, though, we had a report last month that found that U.S. companies paid an average tax rate of only 11%, so effectively half the statutory rate of 21%. So that kind of gap really drives home how critical this issue is, and we need better information to understand the causes to make sure that every single organization is paying their fair share. If it were public, investors could use that information to assess companies' exposure to tax havens and then the risk it represents to their value. Now, I know FASB is still reviewing their tax disclosure standards, but the latest proposal, which I think was from March, didn't include country-by-country disclosures. A growing number of analysts and investors see this information, though, as crucial for their analysis, and they're going to call on FASB to deliver that information. I believe, if I'm correct, 100% of the investors who commented on the proposal, who represent more than $2 trillion in assets, called on the board to make it mandatory to have those country-by-country disclosures. So given that strong feedback, are you now considering including country-by-country reports in your reporting standards?
You are correct. We do have a project on our agenda, and we have received substantial feedback about doing that, and that will be brought to the board in the first quarter of 2020.
So you will be bringing to the board specifically a question to include mandating country-by-country disclosures?
We will have a specific debate about that, and board members will be able to articulate their views as to whether or not that's an improvement to financial reporting, yes.
Okay. Can you tell me a little bit about your opinion on that?
I would like to hear the debate of my board members and see all the research put before, but I can tell you what I've learned today is that you are correct. There are many investors that would find that information very valuable. There are many companies that would say it's very costly to prepare. I question that cost.
Thank you, Chairman. Appreciate that. Moving on. The Global Reporting Initiative released their voluntary standards for tax disclosures just last month, and while voluntary GRI standards are followed by 78% of the companies on Dow Jones Industrial Average, further, Royal Dutch Shell voluntarily disclosed this information last month. Has FASB reviewed GRI's tax standard, and are you considering incorporating it into the GAAP income tax disclosures?
I'm not sure. I'll have to get back to you, but we did review the Royal Dutch Shell disclosure information.
Okay. When would you be able to get us some information on that?
I'll need to talk to the staff about that project and get back to you.
Okay.
Later this week.
Appreciate that. Perfect. Well, that answers my questions. Thank you again for being here, and I relinquish the rest of my time, Mr. Chairman.
My God, that's the first time I've seen that happen. Thank you for your questions, and now I will recognize the gentlelady from Missouri, Ms. Wagner.
Thank you, Mr. Chairman, and congratulations to you. Chairman Golden, members of this committee have expressed concern that CECL accounting standards will adversely impact the cost and availability of credit once fully implemented. We have heard banks of all sizes, and let me underscore, all sizes of banks outline the implications this new accounting standard will have on very popular consumer products, especially during economic downturns. Chairman Golden, after hearing concerns from both financial institutions and Congress, has FASB taken the time to study the likely economic impacts of CECL? And I'm not talking about Treasury. I'm talking about FASB.
We have not done an economic analysis.
Stunning. Did you study how CECL would affect lending or access to credit for consumers before issuing this new accounting standard?
We did a cost-benefit analysis in connection with our mission, which is to provide better, more decision-useful information to the capital markets and other users, including regulators.
Lending and access specifically is what I asked about.
No, we did not.
No, you did not. Again, stunning. I'd like to submit to the record the following article by Accounting Today, which estimates loan loss revenues, or pardon me, loan loss reserves under CECL. Again, Accounting Today, loan loss reserves under CECL could range from, are you ready for this? $50 billion to $100 billion, according to public disclosures made by various financial institutions. Chairman Golden, would you care to comment on this estimate of $50 billion to $100 billion?
We plan to closely monitor the progression of the CECL implementation to ensure that it's been performed with our expectations as to what is the actual
So you don't
effect.
study anything.
We
Now
do-
you're just telling me you're going to closely monitor something like this? $50 billion to $100 billion? Wow, according to public disclosures on loan loss revenues?
We do study the impact of our proposals on the capital markets and other users. We think that the information provided to investors is consistent with how they analyze financial institutions. They'll be able to make more informed decisions that will help our capital markets, and we think that's a good thing. We also think the banking regulators will have better and more refined information, and they can make changes, and we think that is a good thing as well.
A new accounting standard that affects the economy this much should have significant studies backing it. Wouldn't you agree?
I think that's why it's important that we work with the Treasury in consultation with the banking regulators as they
Okay,
perform their
but
studies.
you haven't studied it at all. And
We
we're
have studied-
talking about,
We have studied in connection with our mission that this will provide additional and better information to the capital market.
Chairman Golden, what percentage of institutions will be able to comply with CECL efficiently and effectively?
Based on our discussion with our stakeholders, those that are required to apply at the beginning, we believe are ready. We recently deferred the effective date for private financial institutions, not-for-profits, which includes all credit unions, and smaller public financial institutions, so they have 3
What
years.
percentage of institutions will be able to comply with CECL efficiently and effectively? It's already, the date's passed, it's in.
We believe all those that are required to apply will be able to apply.
Chairman Golden, a number of commentators have suggested that CECL could have a pro-cyclical effect. Can you please describe what impact CECL would have in a recession?
There have been many studies that have been performed. Most recently, the Federal Reserve staff did a study that said leading up to the recession, it would dampen lending and it would accelerate lending during the recession, and therefore be less pro-cyclical than the current model.
I couldn't disagree more. These new accounting standards will have, what it does to popular consumer products, especially during an economic downturn, products that matter to my constituents in Missouri's 2nd Congressional District, mortgages, credit cards. I'm just stunned. I have some questions about LIBOR and so forth, but I will leave it at that. You are compelled, I think, sir, to study this more further, take time about what is the impact this is going to be for real people and for the institutions and the small, especially sized banks that are going to be affected. I'm out of time, Mr. Chairman. I yield back.
I would just quickly comment that all the better information, transparency, information for analysts could have been provided in footnotes or pro forma in the footnotes. I would call that good accounting, And the gentlelady from Missouri would be happy because it wouldn't have any of the economic effects we're talking about. Without objection, an article from Accounting Today referred to by the gentlewoman from Missouri will be entered in the record, and we now recognize for 5 minutes the gentleman from Texas. Mr. Gonzales.
Thank you. I'm here to ask a few questions for my independently owned and operated businesses throughout my district. These businesses will need to access capital several times over their lifetime. Whether it's startup capital or simply because cash flow has a downturn, we depend on our local banks and credit unions to provide access to this capital. And this is the first kind of capital to tighten in response to regulation or accounting risk. I'm very concerned about the consequences of CECL. The CECL standard leaves many questions unanswered, even for those who have already implemented it. The Financial Accounting Standards Board has an important role, obviously, to our nation's standards. Their accounting standards carry the force of the law for our SEC filers, and their independence is an important aspect of the checks and balances necessary for the smooth running of our nation. I see several concerns with CECL. By its definition, it anticipates expected losses and relies on a predictive model for forecasting deficits. In practices, we're now expecting our banks to accurately predict the future and account for it. CECL seems a little too much too late. The financial crisis peaked in 2006. For a crisis response to take 13 years and leave us with so many questions and loopholes is beyond my understanding. Quite frankly, we could have had a financial crisis and recovered from it in time that CECL was developed, in the time that CECL was developed. Ultimately, the problem is not with the accounting standards, but that these standards are going to affect banks' capital retention in a way that accounts and regulators cannot predict. Less capital means fewer small loans. It will be even harder for mortgages of under $100,000, many in my district, at a time when we need to incentivize lending at this level. My concern is that CECL will make lending more expensive in the short term. Lending its lowest and low and moderate income areas. Ultimately, we have a problem in our country getting mortgages under $100,000, and my concern is that CECL is bound to make that problem even worse. My question is, credit unions face challenges on their own in obtaining additional capital retention because of their structure and the way new members are acquired. What would a credit union have to do to generate additional capital to meet a retention rule or regulation?
My understanding is that a credit union would have to retain their income. One of the things about allowing additional time gives credit unions additional time to retain their income such that they'll have additional capital. I agree with you that the FASB does not set the capital requirements for credit unions.
So how does the retention of too much capital affect a bank?
They would, I'd have to get back to you on that.
Would you post a cost-benefit analysis of the impacts of CECL on the affected industries, but especially on banks and community banks and credit unions?
We did a cost-benefit analysis as to whether or not this was additional information, more transparent information at a reasonable cost. We've explained that in our basis for conclusion and other areas, and we're willing to defend that.
What sort of questions would you like to see answered?
Regarding what?
Anything on CECL.
I think it's very important that we study the judgments that are being made, that we understand to make sure there's not recency bias, that there's not conservatism. I've seen recent arguments that concerns that banks will, as they anticipate a downturn, will over-reserve, and then they will not appropriately adjust the reserves as the economy gets better. CECL does not allow for conservatism. It does not allow for recency bias. It requires management's best estimate based on the expected life of the loan. It does that by looking at historical information, adjusted for current conditions, and then a reasonable and supportable forecast period. We are not asking for companies to forecast over the life of the loan, just as far as they think that they can, and then you revert back to historical information.
Well, ultimately, the new standard has produced many concerns that CECL will have the opposite effect than intended, and rather than produce a safer financial outlook in a downturn, CECL could be procyclical and indeed cause problems for us during a downturn by tightening credit too much. Would you share with the committee the studies that your agency has conducted to evaluate how CECL would work in a significant economic downturn?
I'd be happy to share with the committee the analysis that the board has gone through to determine that this is a better financial reporting solution.
Thank you.
We'd like to see that. Thank you, and I yield back.
Thank you. Without objection, I'd like to enter into the record an October 2019 report from the Center for Responsible Lending, a public interest group, which concludes that CECL creates a significant disincentive for lenders to originate loans to low and moderate income families and communities of color. Without objection, so ordered, and the gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes.
Thank you, Mr. Chairman. Congratulations on becoming chairman, and this has got to be like a Jeopardy competition day for you, watching the World Championships. We'll take FASB for 600. Mr. Golden.
Alex Trebek is a constituent friend of mine.
Yeah, God bless him. Mr. Golden, part of accounting tradition is recognizing revenue and expense. Revenue recognition and expense matching is such an important concept. It seems like CECL is not at all in keeping with that in my view. And I want to echo my friend from Missouri's concept that the economic policy implications, the true cost-benefit analysis, not just to issuers versus users of the financial statements, but the big picture is essential. It is a gap. To me, that should be a fundamental obligation of adopting accounting standard. And it doesn't, based on your testimony today, it doesn't exist. So we look forward to what Treasury says. But I think Mr. Lukemeyer and all of us here on a bipartisan basis would say the SEC and the bank regulators were not ahead of this issue. We've been talking about this since the spring of 2015. And yet only in the last year have people started recognizing what a problem I think that this will be. Consistency also is a fundamental tenet of accounting. Would you agree, and would you say that a operating lease at Dillard's department store is treated the same way under GAAP that an operating lease at JP Morgan is? Is GAAP treat an operating lease the same for any business in the United States?
Yes, it does.
Yeah, okay, it does. So by having not a good plan on this FASB issue, credit unions are now exempt from it. Banks under $750 million are exempt from it. And public companies, no matter how big they are all fully responsible to comply with it. Now, that may be in keeping with how we all worry about our small community banks, but the point is now you have a major difference in accounting standards, and I think that's a problem. I do think it's pro-cyclical. I think it will enhance bank losses in a downturn, and I think it could also shorten up terms of loans. Since the way you calculate expected losses, a 5-year loan, people may now avoid making intermediate term loans and make shorter loans, so the financial accounting standard treatment's different. Is that a possibility?
I don't think so. I recognize that point, but the way we have developed the model, the reasonable supportable forecast is just over the period in which one can forecast. You're not required to forecast over 5 years.
Mr. Duhnke, turning to you for 600, I wanted to talk to you about an interesting point an issuer brought up to me, which was PCAOB's inspection of an accounting firm's loan loss reserve papers at a client, and that the Public Accounting Standards Board inspection was very much in conflict with the bank regulators. Have you heard about this issue, that an exam of one of your public accounting firms looking at loan losses are in conflict with the bank regulators? Has that topic come up?
Conflicts are not news to me, but that specific issue is.
Yeah, and it also seems this question concerns about the use of qualitative factors in determining the allowance for loan losses. And the PCAOB auditors to the accounting firm were disputing those, saying they shouldn't be counted, and that the bank in question had a loan loss reserve that was far too high. And in my 40 years of banking, there has never been a loan loss reserve that was too high, probably. So I'd ask you to look into that if you would.
I'd happy to do so.
Thank you. Also, Chairman Duhnke, we've talked about the small broker-dealers, and we've had numerous letters back and forth, and with Chairman Clayton at the SEC. Is that still an issue you think you can find relief for our small broker-dealers under the Sarbanes-Oxley requirement?
We're currently in the middle of our process of addressing the fate of our broker-dealer program. The aspiration is to wrap something up by this year, so hopefully that those questions will be answered.
Well, I hope you'll bring relief to our small broker-dealers who I think deserve that relief in this inspection relief, and we've got work in the Senate and the House on that issue. Nobody's asked you a China question directly yet. In looking at China, as I understand it, besides Belgium, is the only country to not fully comply with PCAOB inspection standards. What's the latest in that?
With one caveat on Belgium, we're working constructively with them and anticipate an agreement. On the China front, it remains status quo. My predecessor gave a heroic effort to try to reach some accommodation with the Chinese, and we have been unable to do so. So we're at the same place we were a couple of years ago, and that is unable to inspect or enforce in China.
I know Congress thinks this is an important issue. We look forward to working with you in the coming days. Thank you, Mr. Chairman.
Thank you.
Now I recognize the gentleman from Illinois, Mr. Casten.
Thank you, Mr. New Chairman. Thank you to our witnesses. I want to pivot away from CECL. I have opinions on it, but I come at this as a new member of Congress who spent 20 years in the energy industry, and having had to restate our entire books when FIN 46 came out and changed the variable interest accounting rules, where you could only really understand what our business did from reading the footnotes. I'm not wild about changing accounting standards, but you can manage it. I also want to emphasize that in an ideal world, accounting standards are value neutral, politically isolated. But again, from the experience I come from, I don't have any experience with non-politically influenced accounting standards because our tax books are politically influenced. And if you're a regulated utility, whatever the utility books are for your rate-making capital is politically influenced. So there's no way that you don't have a set of accounting records that are subject to some political influence just because FASB is independent. And of course, there's significant discretion in do you take a capital expense, do you take an operating expense, and how do you use that to smooth earnings? Because we have our own political constituencies we respond to as business leaders. So all that's okay. But I think the question, if we can't get away from political influence, is how do we deal with the reality that we have? And so with respect to CECL, the idea that banks have to book a reserve for some statistical likelihood of a future credit liability, and yet a business doesn't have to book a reserve for a whole host of other future statistically possible liabilities, from customer loss to climate change or what have you. Chairman Golden, could you just explain to us very briefly what it is about CECL that leads FASB to conclude that that type of future risk should be booked, but other types of future risks shouldn't?
Sure. The CECL is designed to show investors what are the cash flows the company expects to receive from the financial instrument on the books. One is trying to forecast based on historical information, current conditions, reasonable and supportable forecasts of economic conditions. What are the cash flows that one expects to collect? If one expects to collect 100% of the cash flows, there is no loss. It's quite clear in the standard that if an entity held a U.S. Treasury bond, there would be no loss because it's risk-free.
So, but is it solely because CECL derives from regulation that the loss is booked? Because I could say I own a property in Miami Beach that's going to have significant flooding, and any scientist could sit there and say, yeah, you've got a serious exposure there, but that wouldn't be a bookable loss in the way that a CECL would be.
That's right, because the flood, the event that has caused your loss associated with the flood has not occurred. The event that has caused the risk to the financial institution has occurred because they've either purchased the security or they have originated the security.
Okay, so let me then shift back to my utility world. In 2013 or so, the EPA said that essentially all existing coal boilers under their Boiler Act rule were going to have to come in to put significant back-end controls on or shut down. It was a change in law. It meaningfully affected their cash flows. There wasn't a single utility or operator of a boiler that booked that loss on their books or booked that liability on their books. And this may be too far down in the weeds, but do you know what the difference was of why that didn't get booked as a loss?
I'm not familiar with that fact pattern. I'd be happy to talk to you further to better understand why that was the case.
So I'm not trying to play gotcha, but the difference was that was all the accounting groups said that was an obligation to invest in an asset as opposed to a liability. Same cash flow future impact, but one of those never showed up on books other than that people understood it. And so it was a CapEx, OpEx piece of distinguishing. So it sort of fell out of the accounting records that we're sitting there saying this business is materially affected, but you wouldn't know from the financials. So with the time I got left, my question for you is, if you can't take away that there will be political influence over accounting standards, and I'm not advocating either of these extremes. One extreme we say, we throw our hands up, we say do whatever you want. The other extreme we say FASB should be a branch of government, right? I'm not suggesting either of those extremes. What could we do as the Congress when we pass these laws, whether they're environmental laws or tax laws or otherwise, to provide you with more clarity as to how to interpret so that business owners aren't sitting there saying, I have to wait until all the FASB members complete the comment period so we can figure out how these will go through? Because to my mind, that's the real risk. Is there something we can do in our legislation to provide you with greater clarity?
I don't know. I'd be happy to think about that. What comes to mind initially is strong and better enhanced communication between all parties.
Okay, I see I'm out of time, so thank you. Yield back.
Thank you. Been informed that Mr. Steele from Wisconsin has his questions ready to go and is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Thank you for calling today's hearing. Mr. Golden, question for you. As you know, many insurance receivables are important for assets for most property and casualty insurers. And reinsurance programs vary, and the National Association of Insurance Commissioners standards reflect that, both from an accounting and regulatory capital perspective. However, CECL treats all reinsurance receivables the same, and that seems to be causing friction between GAAP and the NAIC's statutory accounting principles. And I've heard concerns from numerous folks that CECL is simply incompatible with the way that insurers are currently conducting their business model. And the standards treatment of reinsurance receivables, I think, is one good example to kind of dive in to understand this with. This isn't a purely academic issue. It's the way CECL affects the treatment of balance sheet items like reinsurance receivables affects the way that those insurance companies are doing business and thus ultimately impacting policy holders. Can you give color as to how FASB worked with investors to determine whether insurance-specific changes would improve transparency?
Sure, and you're correct. Insurance receivables are within the scope of CECL. We believe that the same accounting conclusion should be given to the same activity. And in essence, a reinsurance receivable is a receivable just like any other receivable. It's the same as a trade receivable. We have a specific group that is designed to help the board understand implementation questions, to help the board narrow diversity, to help the board become aware of when we need to provide additional educational material. We specifically put a property casualty representative on that committee to help us understand if there are things that we need to do to provide additional education or narrow diversity.
So let me try to refocus the question a bit. How does that assist investors, in particular as it relates to transparency? Do you believe that this improves transparency to the benefit of investors?
Yes, we do. What it does is it allows the investor to understand the real risk related to the reinsurance receivable.
Okay, so let me follow up. So as you know, CECL requires each financial institution to conduct its own modeling in order to determine their loss reserves. And so because of that, it would appear that investors have to evaluate all the different models firms are using to determine the health of their loan portfolio. And this seems to be able to adding complexity and uncertainty rather than enhancing transparency for investors. And in fact, I've seen reports that investors are calling on companies to include both the current allowance for loan and lease losses and CECL loss reserves in their reporting. Can you address some of this confusion as to how you're seeing this play out to enhance investors?
We've had a lot of dialogue with investors to help them understand the additional information they're going to get from CECL. One of the crucial things we believe for the success of CECL is that it is a very flexible approach. It's a principle-based approach. We specifically did that so that management would have the flexibility to do their reasonable and supportable forecast based on their specific banking book. We didn't want to mandate one model, one way to do that. As a result of that, there needs to be additional transparent disclosure as to how management has arrived at their estimates.
I appreciate your feedback. I don't know that I agree with your conclusion. I'm going to take the remainder of my time and yield to my colleague with reams of paper to my left, Mr. Luchtenmeyer.
Thank you, Mr. Steele from Wisconsin. Just to follow up on the question here, you're talking about investors who, quite frankly, I can sit here and I've got, as you said, piece of paper after piece of paper that says, here's a headline, investors, one new accounting standard says FASB, investors disagree. Here's one from the former FDIC Chairman William Isaac from an op-ed for this past year. In January 2019 survey by Janney, the Lord Investment House found that 75% of bank investors oppose CECL. Here's one from the tax accounting Vice President of the American Bankers Association. 3/4 of investors oppose. Here's an FIG Partners survey that says 85% of investors feel current accounting rules for banks, U.S. bank reserves are sufficient, and 83% believe it's pro-cyclical. So where in there is the urgency to have this change for the transparency of investors for thousands of individual entities that are affected for the benefit of the 400 banks that are publicly traded?
We took on CECL because there is evidence that the incurred loss model delays loss recognition, created procyclicality, and caused complexity and confusion because of the need to change.
Created procyclicality? It's going to exacerbate it, sir.
I'm just talking about the incurred loss model. During the financial crisis and subsequent to that, it was quite clear that investors were not using their incurred loss model. They were using an expected credit loss model. We also, during that time, received feedback from investors, from preparers, from banking regulators, both U.S. and global regulators, that we should make a change and focus on expected credit losses.
You don't think mark-to-market had anything to do with this downturn? I'll yield back.
Yeah, thank you. The Financial Services Committee has 3 full committee chairmen on it, including the new chair of the Government Reform Committee, or Oversight Committee, and the former chair of this subcommittee, the gentlelady from New York, is recognized for 5 minutes.
I thank the gentleman for his leadership, for recognizing me, and congratulate him on his new chairmanship on this critically important committee. Before I get to questions, I just want to say that both of these entities, the Financial Accounting Standards Board and the Public Company Accounting Oversight Board, are very important, and I certainly strongly support their missions. The PCAOB directly regulates auditors of public companies, so we should treat them the same that we treat other financial regulators. We give financial regulators significant independence, but in return, we require significant transparency. But the PCAOB is not subject to the same transparency standards as other financial regulators. Specifically, they're not subject to the Freedom of Information Act, even though other financial regulators are. So I just want to say that I'd like to explore subjecting the PCAOB to the Freedom of Information Act in order to improve the transparency of this tremendously important regulator. And with that, I'd like to get to some questions for Chairman Duhnke. In December of 2018, the SEC and the PCAOB issued warning to investors about the challenges American regulators face when attempting to conduct oversight of U.S.-listed companies based in China and Hong Kong. According to the SEC, there are 224 companies listed on U.S. exchanges with auditors located in countries that prohibit the PCAOB inspections of financial details. They have a combined market cap of more than $1.8 trillion. Chinese law, in particular, restricts access to accounting information, citing national security and state secrecy. But buying shares in a company that can operate under completely opaque auditing standards or oversight is really more of a bet than a true investment. So I'm very concerned that investors are not adequately protected. I can't help but think of the Enron scandal, which spurred the creation of the PCAOB. So how are these 224 companies able to list on U.S. exchanges in the first place? And are there any nations other than China that restrict access to accounting information? And besides directly negotiating with China to access accounting information, what can be done to best protect investors?
A couple of things. How are they listed? I'll stay out of the SEC's jurisdiction, but to connect it to the PCAOB's jurisdiction, they require a PCAOB registered auditor, which they have, and that allows them through our process to be listed on our exchanges. And how do we protect people? The statement you referred to was one of the steps that Chairman Clayton and I took. We thought it was important to make sure the market knows exactly what the status is so that they know what they're getting and not getting out of the process. We do a number of things at the PCAOB. We update and keep updated our website to make sure those who wish to find out what the status is, they can get it and understand what the current situation is. Anytime I have an opportunity to include this one, I'll speak publicly about our lack of access on inspections and enforcement front. And it's at this point, it's a buyer beware situation that people should know whatever protection they glean from our activities, they do not have them in those instances.
Thank you. Independence is absolutely critical to the integrity of an audit. And under Sarbanes-Oxley, auditors are prohibited from providing services that, among other things, could create conflicts of interest or result in their acting as an employee of their clients. And in the last few years, the PCAOB inspections have found numerous violations by auditors of the independence rules. So do you know what evidence the SEC is looking at to suggest that there needs to be a loosening of auditor independence rules?
Once again, I would defer to the SEC on their particular process, but our interaction with them is through our rules and standards, and that's what we would address.
Okay. And we don't have anyone here from the SEC, so. Okay, I yield back. Mm-hmm.
Thank you. The gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes.
My pronouns are he, him, and so, gentleman from Ohio, Mr. Davidson. Thank you all very much for coming today. I always enjoy talking to FASB and appreciate the chance to talk about the public company side of that as well. As a smaller business owner, investor, I've experienced some consternation with FASB, and I just want to better understand how FASB goes about assessing the impact of decisions. So previous decisions that I think perhaps have been not accurate or effective, helpful for the market would be mark-to-market as an example. The way that was implemented, there might be times where it would be rational to mark-to-market. But why change the entire depreciation schedule for an asset when there's no planned leverage and no planned disposal of the asset? And another one is the distinction between operating and capital leases. Why obliterate that line that's been pretty well time-tested, very well understood, and it all allows for misapplication in banks. So as the regulators apply them, It could be dynamic. Cynics might say that this is an opportunity to create deal flow for the investors that serve on some of the boards. Others might just say maybe the companies here are bigger and they're looking at it from a more academic perspective and they're not adequately understanding the impact. So I guess, what kind of testing does FASB perform before issuing standards? Does FASB engage in rigorous testing, engagement with industry, and cost-benefit analysis? Do you share that research?
Sure, let me address that with respect to the improvements we made with respect to lease accounting. Before we take on any project, we can trace it back to some issue in the capital markets. With respect to leasing, as a result of the Enron and WorldCom events, there was a request by Congress that the SEC do an off-balance sheet study. They completed that off-balance sheet study, and the number one observation was operating lease accounting. At that point, we took on a project to determine if putting leases on the balance sheets would be decision-useful information to investors. We went out to investors to look at, were they already putting operating leases on the balance sheet? And if so, would the board's measurement give them better information? And we think it did give them better information. Since I've been chairman, we have created the Private Company Council that is specifically designed to give the FASB input on what private companies think about our proposals, what are some differences that private companies should do to save costs. One of the most significant achievements that we've had there is reducing the amount of disclosures for private company preparers, because we don't believe investors of private companies need the same amount of disclosures as public companies. We also ask them, is there a more practical way in which to apply our standards? And with respect to leases, we did work with them to come up with a different discount rate philosophy.
Okay, how much influence does the SEC, which oversees FASB, and and of course they're overseen by Congress, how much does it have on FASB's work? So if you look at the influence of the SEC, I appreciate that you're creating this privately held company. You don't necessarily want to create two entirely different standards, but perhaps you do if you're going to do things that really are relevant for the kinds of investors, institutional investors, and the kind of capitalization structures that are markedly different.
Yes, we have had some successes with our Private Company Council to change quite substantially and have a different accounting for private companies. One is with respect to goodwill. With respect to your question about the influence that the Securities and Exchange Commission and their staff have, we work closely with the Office of the Chief Accountant. We work closely with the Chief Auditor of the PCOB, with the banking agencies, and with others that use our information. We want to make sure, and the input we're seeking from the SEC is, are the standards enforceable, as well as they, through their Corp Fin review, see differences in opinion that are out there, we can narrow that diversity. If they have questions that can help them in their reviews or enforcement matters, we work with them to do that.
I appreciate that. I wish I had more time to go into a whole range of issues. I think Cecil's been covered fairly adequately, but I think it's indicative of decisions where there's a lot of theory and not a lot of practice. And I appreciate the effort with the Private Company Council, and maybe you look at it from different perspectives, as has been suggested with the way that Cecil came to be. Thanks.
Thank you. Now I'm pleased to recognize a gentleman I've been sitting next to for over 20 years on both my committees. The gentleman from New York, Mr. Meeks, who is also chair of the Subcommittee on Consumer Protection and Financial Institutions, is recognized for 5 minutes.
Thank you, Mr. Chairman. I'm going to talk to Chairman Golden, but I've been running around and talking to a number of folks and understand that switching to CECL accounting method, they all tell me will have significant real-world impacts on community banks, minority banks, and other providers of credit and banking services. Fact of the matter, many small financial institutions have struggled since the financial crisis, and they seem to think, and I may agree with them, that CECL is likely to be an additional blow to the dwindling number of community banks and minority institutions. Small community banks have been disappearing at an alarming rate since the financial crisis, specifically the number of minority depository institutions, which has fallen from 215 banks in 2008 to fewer than 150 today. According to the FDIC, following the financial crisis, minority banks were 2.5 times more likely to fail than all other banks. Today, MDIs represent 2.8%, only 2.8% of FDIC's insured banking charters, and 1.3% of assets. This matters because research confirms that MDIs play an active role in addressing persistent discrimination, as they are far more likely to serve underbanked communities of color and low and moderate income communities than both large banks and non-minority owned community banks. I say all this because when I engage with these banks and I start talking to the MDIs about the challenges they face and their principal concerns going forward, CECL systematically is at the top or near the top of the list of their concerns, just about everyone that I spoke with. Crucially, a negative impact on small and mid-sized financial institutions will also reverberate to lower income and middle-class Americans. If these financial institutions curb lending and restrict credit, low-income individuals could see their cost of borrowing rise or lose access to credit altogether. Moreover, if CECL causes further small lenders to close their doors, the already growing problem of banking deserts and unbanked individuals will be exacerbated. Given these serious potential economic disruptions, let me ask you this. In response to questioning in this committee, banking regulators, and we've had them here, acknowledged that CECL will have a material impact on capital and may impact availability of loans of marginal communities, but all they can do is to seek to mitigate any such impact if FASB finalizes its rollout. So my question to you is, can you say, almost definitively without a study or anything else, that CECL implementation will not increase costs or reduce access to credit for low-income communities and communities of color, which have already faced well-documented hurdles accessing credit?
There will be a cost to transition to CECL, but we think the ongoing costs to apply CECL are similar to the cost today with respect to the incurred loss model. With respect to the availability of credit, I think that's directly dependent upon the regulatory capital associated with the change.
So you think that, my concern is the ramifications are so crucial, and that's why I'm so focused on making sure that there's a complete study beforehand, so that because once a bank or you lose access to credit or MDI closes, it's not going to come back. And so my concern with a major shift like this, that let's make sure, let's dot our I's and cross our T's. So if in fact CECL's implementations curtails access to credit or the cost of credit for low-income communities of color, is there any opportunity? I don't know, is it possible, or would you be open to repealing and reconsidering and trying to think of some alternative ways to accomplish the intended accounting transparency rules without negatively impacting bank capital?
We're always open to improving our standards, but most of the financial institutions, if not all of the financial institutions you're talking about, are not going to be required to implement CECL until 2023. There'll be a lot of information about the CECL rollout for the larger public companies that I think we can all review and study before those financial institutions you're talking about are required to implement CECL.
See, unfortunately, I'm out of time.
I'm sure the gentleman is gratified that the impact on low and moderate income families and families of color will be delayed to some degree until 2023, by which time I'm sure we won't have any problem for low and moderate income families by then, we hope. With that, I will recognize the gentleman from Indiana, Mr. Hollingsworth.
Chairman Golden, earlier in your opening statement, you had said some percentage, I think it was in the 80s, of total banking assets that CECL was going to go into effect upon as of January 1st. What was that number?
I think I said the vast majority.
Okay, so we should be comforted by the fact that the vast majority of banking assets are already going to be subjected to this, and we will get the results of the vast majority of banking, of impacts, and then we'll make further determination afterwards. I want to associate myself with the many comments on both sides of the aisle, the many letters that have gone back and forth expressing deep and grave concerns over CECL going into effect. You and I and others have had meetings about this where it has been explained to me that this is merely a temporal effect. We are taking those losses that are going to be incurred over time, and we're just asking them to upfront characterize those rather than over time characterize those as though that is some small and minor effect. I deeply, strongly, and vigorously, as we discussed before, believe that that creates a lot of pro-cyclicality, which will be problematic going forward. We have read over and over again from economist after economist about some of the challenges the Fed may have in working through the next recession, given where interest rates are, given the quantitative easing that they have already undertaken in the past, and given subdued inflation. So I am really concerned that we are setting ourselves up for an even larger problem going forward, caused by accounting. I think that puts us in a very precarious position, and I would rather see us develop counter-cyclical ballast to this economy rather than more pro-cyclical problems. I will let others and yield time to others to talk further about that, but rest assured, I feel as they do about the concerns on this. I wanted to address something else with you. In 2012, Congress passed the Jobs Act to expand the options for business to raise capital through exempt offerings and attract more private companies to public markets, which I think is a really laudable aim. When you are discussing FASB reform efforts on liabilities and equity, you've noted that this is an area where private companies and other smaller public companies might be disparately impacted by the complexity and confusion of the current standard. I wondered if you might talk a little bit about whether you take into consideration EGC, on-ramp status, or other things in thinking about some of these rules as they come on board for public companies that are smaller.
Yes, absolutely, and I hope before my tenure as the FASB chairman is done at in the middle of June this year that we're able to complete a substantial improvement to simplify the distinguishing characteristics between liabilities and equity, which will allow us to decrease the number of restatements and reduce costs for those that are emerging companies. With respect to the Jobs Act and emerging growth companies, we recognize that there is a benefit of deferring effective dates for smaller public companies. And we instituted a new philosophy that we worked on throughout 2019.
Can you explain to me what that benefit is that you recognize?
That they're able to learn from public companies, that we are able to see an entire audit cycle, an entire Corp Fin review cycle, that the board can provide additional education material, narrow diversity, or make cost-effective changes before smaller public companies, private companies are required to implement our standard.
Got it.
In the past, we used to have a 1-year spread between public and privates, and going forward, we'll have a 2-year spread. That said, on CECL, we're having a 3-year spread between when the public companies are required to go, when the private companies, the not-for-profits, and the smaller public companies.
All right. This continues to be an important aspect that this committee and other, frankly, people are talking about. And with that, I'm going to yield the balance of my time to the gentleman from Missouri.
Thanks, gentlemen. Quick question for you, Mr. Goldman. You talked about the need for this with regards to transparency for investors. And basically, at this point, it's only the publicly traded companies, which is basically 400 out of the 5,000 banks, and it doesn't really include the 6,000 credit card companies. But if you go down the line and you talk about the GSEs, auto loans, insurance companies, even reinsurance companies, you're talking thousands and thousands and thousands of entities out here for the benefit of 400. Tell me how that works. Tell me how you can justify supporting 400 at the expense of thousands of other folks and driving some of these folks out of business when you look at the costs that they're going to incur, especially for credit unions and small banks.
I believe by allowing a 3-year spread between public companies and smaller financial private institutions, we will be able to look at the use of CECL, the application of CECL. We'll be able to narrow any diversity. We'll be able to have additional cost savings before the community banks, before the credit unions are required to implement CECL.
I see my tire's expired.
I'll yield the time back.
Now recognize the gentleman from Illinois, Mr. Foster.
Thank you, Mr. Chair. I was just musing over this, the business of pro-cyclicality and counter-cyclicality. Speaking more generally, are there areas where we could introduce more counter-cyclicality into accounting generally? Just cast a wide net initially, and then I have some specifics.
I don't have specifics of other standards. What we try to do at the FASB is we try to increase the decision useful, neutral information to investors that gives them better information so that they can allocate capital, so they can decide where they want to lend, and so other users can make more informed decisions. We believe allowing investors to better allocate capital reduces the cost of capital, helps make our capital markets more liquid.
Absolutely, and the difficulty, of course, is that, you know, and then there's a bubble building about to collapse. That is the biggest misallocation of capital. You know, the real estate bubble that we experienced a decade ago is probably the biggest misallocation of capital in human history. And so I was just fishing for accounting principles, you know, sort of the general principles I was thinking of was just to treat skeptically the value of recently appreciated assets. You know, for example, don't use the mark-to-market price, but use some average over the last few years to get a better idea. This thing would, you know, this sort of principle, if applied throughout accounting, would really do a lot towards dampening bubbles and sort of automatically retracting the punch bowl as the party gets going, if you get my meaning. I was wondering, are there examples of options you had and considered where the cyclicality you know, could be used as the deciding factor in leaning the scales to stabilize the system?
I cannot give you any specific examples at this point other than, like I said, our process is designed to ensure that investors are getting better, higher quality, more decision-useful information.
Okay. Well, if things occur to you, or if you come back with a more considered reply, either
we'll be happy to.
Yeah, I'd appreciate that, because that's something that we can do to, as I say, stabilize the system. And now, if I will just yield the remainder of my time to my colleague, Mr. Meeks.
Thank you. Let me, and the chairman just indicated, which I agree with, that for the small community banks and MDIs, this does not take effect to them until 2023. And I think that that's as a result of a lot of individuals. You listen to the comments and a lot of noise, because otherwise, if it wasn't for them, it might have moved forward, but you heard them. So the question then is, do you have the capacity to do the kind of research and investigations, even though it's not to, you know, to determine where we're going with this? Would you agree to work with the feds in trying to get something done in that regards? And then what will you do with the information once you finish, you know, and do a complete study, particularly as it pertains to the community and small banks?
We have sufficient resources at the FASB staff. Reviewing the information that comes from the capital markets of our change is not something new. We did it with respect to revenue recognition. We've done it with respect to lease changes, and we plan to do it with respect to CECL changes. As I said in my opening remarks, we stand ready to help the study that's mandated by the U.S. Treasury in consultation with the banking agencies. We look forward to reading that study. If there's any recommendations that come out of the study, we will carefully implement those recommendations.
So, because, you know, one of the things that I took out of the decision to have implementation for all of the largest financial institutions is that you then understood that CECL's impact had not been adequately studied in a quantitative manner. And so I hope that there's a quantitative study that's going to be done now. And once that quantitative study is completed, you know, and you see that the standards, you know, it will have an effect on these banks as well as low and moderate income communities, that those findings then will be implemented and we don't continue. Even, you know, we're talking about 2023, sometimes there's a delay, you do a study, there's no action as a result of the study, and then the same thing takes place and the same damages because of the cost. So I'm out of time. I just want that to be very concerned. I do, give you credit for listening to people, though, the first time and pushing it back to 2023.
Thank the gentleman from New York and recognize the gentleman from Ohio, Mr. Stivers.
Thank you. My pronouns are also he and him, and I appreciate you getting them right. I want to thank you both for being here. And my first question is for Mr. Golden. So the CECL change has been explained by some people as the biggest accounting change in 40 years. I'm not going to ask you whether you agree that it's the biggest change in 40 years. Would you believe it is a major change or a minor change?
I believe it is a major change for financial institutions.
I think so too. Can you tell me, did you engage in any field testing?
We had 25 meetings over the course of the project where we went to the company's sites and did field work.
And did you do comprehensive cost-benefit analysis?
We think that our process was comprehensive. Again, the cost-benefit analysis was in connection was this going to give better decision useful information to investors?
So you looked at it only under the lens of does it give more information to investors, not a total cost-benefit analysis?
We understand we try to understand, is this going to give the investor better information about make more informed decisions? What are the costs that companies will incur to comply with the standard? That's how we've done our cost-benefit analysis, and that's what we did on this. We also produced a document that describes, in essence, plain English, how we described and considered the cost and benefits.
And did you look at any potential market instability created by CECL or procyclicality?
I don't recall looking at anything related to market instability.
Great. I think you should look at all of those, and market instability is pretty important. And I will tell you my concern about CECL is I think it's a rule for accountants by accountants, which is 10 years too late. It's unnecessary, and it drives pro-cyclical behavior and forces capital into artificially restricted buckets. We need capital to protect insolvency and against future problems everywhere, not just restricted capital. Restricted capital might be available, it might not be available, given what's going on and what the problem is, and that's my concern about CECL. So I've talked to the Federal Reserve about looking at CECL in accordance with their total capital standard and sort of adding it, giving credit for the CECL reserves as part of capital. But that still doesn't solve the problem because it is restricted capital, and I'm very concerned about that. So I am going to be pursuing some legislation to require the Securities and Exchange Commission to put some controls around FASB because I'm very concerned about no testing, no looking at what's going on with regard to market instability and the impacts, because cost-benefit analysis needs to look at what happens and what the outcome of that will be, not just the cost in a myopic way of do investors get more information. And there's a whole bunch of private institutions that'll have huge costs related to CECL too. So I'm very concerned, and I'm going to be looking at some serious legislation as a result of it, and that just is what it is. I also want to ask Mr. Duhnke about our decline in initial public offerings that we've seen over the last 2 decades, frankly. And I know it came up in the Jobs Act question. They are sort of related, but we've had a decline because of the cost of compliance and the cost of going public in companies choosing to go public and take an IPO. What is the PCAOB doing to look at regulatory costs that are reducing the number of companies that are public, because that means less investments available to mom and pop Main Street investors. If you're a private company and not a public company, it's not available to my Uncle Bill, but if you're a public company, it is. So what are you doing to try to look at that?
I think the most directly relates to your question is when our inspectors go in and do an inspection and they require documentation from audit firms, that request and that demand can extend to the company, which can make them incur more additional costs. So we're very focused on that to make sure that we're not exceeding the requirements of our standards.
how do you streamline those regulations to make sure, and processes to make sure that the process is not overly burdensome? And I want to make sure you get the information you need, but what are you doing to make sure you're not overly burdensome in those contexts?
It's less a question of how do we change a standard to how do we implement a standard.
Okay.
We can do it through our inspections process.
Great. Chairman Golden, as far as FASB goes, do you think there are any rules, accounting standards that have come out of FASB that have resulted in precipitating that decline of IPOs over the last 20 years?
No, I don't. I actually think it is, I think the standards that we put forward have helped our capital markets. As I talked to the gentleman earlier about the differences we made for private companies, we're careful to make sure that the differences do not impact entities' abilities to go public. And so far, we have discovered that it does not.
I hope that's true, but I really worry that the burden you place on companies in a quest for more information for investors drives up the cost of companies going public, discourages companies from going public, and has precipitated the decline of initial public offerings, which means mom and pop investors get less access. Thank you. I yield back.
It's now appropriate to recognize members of the full committee who are not members of the subcommittee, starting with the gentleman from Missouri, Mr. Lukemeyer.
Thank you, Mr. Chairman. Mr. Goldman, you just indicated that you believed that CECL is a major rule. Do you think mark-to-market was a major rule?
Yes, I do.
How'd that work out?
We've made a number of changes.
Then not so hot. You had to rescind it, right?
We did not rescind mark-to-market. We changed the thing you're noting that occurred here had changes to where mark-to-market was.
But exacerbated the downturn, and you had to make some tremendous changes in that to make it actually stick around.
You're correct. We did.
And you did no study, you did no benefit cost analysis on that before you implemented that one. Is that correct? That's what you told me in private before. I assume that's still correct.
I believe that's correct. But
okay. So here we have another major rule that could have a similar dramatic impact on our economy. And again, we did not study, did not go to individuals, did not go to the private sector, which is going to have to implement this rule and on a day-to-day basis and figure this out. You had no concerns about this at all, is that right?
No, I recognize the concerns of this committee and the concerns of the various financial institutions. We take those concerns.
Yeah, but not before you made it and not before you implemented it, apparently. Otherwise, you would have made some changes or not ended it at all.
It's very, I think CECL is an improvement to investors. I think it will help the public capital markets.
Well, with all due respect, Mr. Goldman, I think this is a solution in search of a problem. I think you've structured this thing completely wrong. You got it to the benefit of 400 companies who don't want it, investors who don't want it to be able to analyze those balance sheets, and at the expense of the other thousands and thousands of companies who are going to have to implement it and their costs and the effect on their customers. In this committee, not too long ago, we had a gentleman from the National Home Builders Association who indicated that for every $1,000 worth of increase in the cost of a home, 100,000 people got priced out of a home. They couldn't afford the home to go for a mortgage anymore and live the American dream of having a home. Question for you. Did you ever consider the effect on the real people in the real world when you proposed this rule?
Our thorough process was based on consistent with our mission, whether or not this.
So you didn't talk to the real people in the real world who are going to have to deal with the effects of this, which means that when the banks and the credit unions have to implement this and be able to find enough resources to put into the reserves, they're going to have to raise the price of their products, especially for small banks and credit unions. Where are they going to get the income to be able to address these reserves? And I can tell you, I've got a study sitting right here with regards to the credit unions. They're going to have one association gave me a study that says it's going to cost $14 to $15 billion. Where do you think that comes from? Are you concerned about that at all?
Yes, and again, that's one of the reasons why we gave an additional year for community banks and for credit unions, and so we can monitor the implementation for the public companies and stand ready to make.
Again, with all due respect, Mr. Goldman, monitoring after the fact shows the negligence and incompetence, in my mind, when you have mark-to-market that you already had in place in the past that didn't work without a study or a cost-benefit analysis show that wouldn't work. And now you've done the same thing, and you're sitting here trying to implement something again and monitor after the fact. To me, that's the definition of insanity. Doing the same thing over and over again, it doesn't work. I mean, it just blows my mind to see what you're doing. There's no federal agency that would be able to get away with what you just did. Do you realize that?
We did a very rigorous cost-benefit analysis in connection with our mission.
No, you didn't. No, you didn't. You told me you didn't. Either you fooled me before or you're fooling me now, because you told me in our private meeting that you didn't do a cost-benefit analysis and you didn't do a study on this. So which one is it?
We did a cost-benefit analysis in connection with our mission as it relates to...
Well, your mission, but that's not on the customers it's going to affect.
Right.
How many people is it going to take? How many people is it going to take to get your attention that this is going to affect real people in the real world, sir? I deal with the real world. I'm a business guy. I sit across the table from real people. I'm a legislator. I sit across the table from my constituents. I go home every week and talk to them. These people are going to be hurt by your rule. A simple accounting standard is going to decimate the people in my district's ability to have home mortgages. And it's a bipartisan effort. My friends on the other side of the aisle are as upset about this as I am. This has got to stop. This can't continue. You should stop and look at the damage you're going to be doing to the citizens of this country. And in essence, after that happens, it's going to devastate our economy. The ripple effect is going to be up. And without a study, you can't prove me wrong. I hope you can prove me wrong, because I don't want to see this happen to my constituents. And the study, by the way, that the Treasury is going to do, that's my study I requested. And I hope you do work with them on this, and you do implement their changes, because hopefully it'll show that this has got to be changed. This can't continue, sir. With that, I yield back.
Thank you. We'll now recognize the gentleman from Ohio, Mr. Gonzales.
Thank you, Mr. Chairman. I think the independence of FASB generally is a good thing, right? I think generally speaking, it's been positive. And I think you don't want us making your rules for you. We don't have that expertise. Blaine does, but a lot of us do not. Having said that, I can't help but echo the comments that others have made with how irresponsible the Cecil decision feels from the outside. So you've testified multiple times. You've made Cecil is consistent with your mission to provide useful information to investors, correct? And you believe because there are exclusions for smaller banks, you believe you'll be able to know the effects ex post, and you may correct course, correct?
Correct.
Okay. But you've also testified that you could care less about the real-world economic impacts of the decision to implement Cecil, because you are solely focused on your mission, which is a noble mission, I grant you. But it's not clear to me that anything that you see going forward, unless it is that investors are complaining, would ever force you to course correct. And so I don't, it's hard for me to square that. You either consider the economic real-world impacts, in which case you should have done it before Cecil, or you don't, in which case anything that happens is going to be immaterial to your decision to change.
One of the items we're looking forward to see the results of the Treasury study is the impact on regulatory capital. And I think it's very important to understand how the impact on regulatory capital impacts the types of things that Mr. Lukemeyer is talking about.
Okay. Again, I'm going to give the gentleman from Missouri time in a second, but I want to switch to Chairman Duhnke. I want to talk to you about China specifically. It doesn't make any sense to me why Chinese firms should be able to avoid audits when American companies have to go through that process. Do you need legislation from us to enact that change, or can you do this through the regulatory environment?
Well, the process that we follow is inspection, if there are violations, enforcement, resolution of the enforcement issue, and then whatever the sanction might be. So the sanctions can be anywhere from something minor to a fine to deregistering of a firm. And just to make it sure we're clear here, we're not talking about Chinese companies, we're talking about auditing firms. That's who our jurisdiction is over.
Right.
So then once a decision for deregistering takes place, that implicates the SEC's world.
Okay.
They have to look at listing standards and whether or not they would continue to qualify.
And how far along are we in terms of getting China up to those standards in your estimation? Are we close? Are we far away? Where are we at?
Let me be more specific than saying close or far away. We require sort of a three-pronged principle before we enter a negotiation with somebody for an inspections and enforcement agreement, and we have yet to reach agreement on those principles with the Chinese. Whereas it's accepted by every other bilateral relationship we have, they have not accepted it, so therefore we have not been able to enter any substantive conversations.
Okay, and we'll follow up. I'd like to hear more on how we can be assistive in that. And with that, I'll yield to Mr. Luetkemeyer.
Thank the gentleman from Ohio. Mr. Goldman, I think that this standard is going to have a dramatic effect on the capital and reserves. As I said a while ago, I've got something in my folder with regards to one group of credit union associations, $14 billion. I think I was talking to some FDIC folks yesterday, and they've got a couple banks. One of them is $4 billion, another one's $30 billion. It's going to have to do some additional reserves. How big an impact do you think this is going to have? Have you ballparked it at all? I mean, Ms. Wagner talked a while ago about 50 to 100 billion. I think we're going to blow past 100, but have you got an idea? Is it concerning?
I do agree that there's a significant increase in the allowance, which is a direct impact associated with capital. We do observe that the banking regulators have looked at that. They have given a transition, which will make it easier, and we look forward to seeing the Treasury report as to the totality of the impact on regulatory capital.
How big a number does it take before you do something?
I'm sorry, I didn't.
I say, how big a number is it going to take to get your attention and you make some changes or scrap this thing?
We have our attention now. We don't set regulatory capital. So to the extent that this is required to impact and increase regulatory capital, that's not in the space of the FASB. We write standards that neutrally reflect the economics. We don't write standards to impact regulatory and bank capital.
Oh, sir, well, as my friend Ohio probably put very succinctly here, your lack of concern for the citizens of this country is breathtaking. Your inability to see the economic impact on our economy as a whole is breathtaking. That doesn't concern you?
No, it absolutely does concern. What I'm saying is that we need to work with the banking regulators to better understand what types of capital changes they're going to do as a result of this.
Okay, so my question then, I restated, what number gets your attention? 100 billion? 200 billion? At what point do you sit down and say, whoa, this is too much. We've got to scrap this thing and completely do something different?
I don't know the specific number, but this hearing, the results, you have my attention.
How big a number do you think it takes? Can I get a ballpark?
I don't know.
Well, sir, I appreciate the additional time from the chairman, but this really concerns me.
Thank you.
I yield back.
One announcement about future hearings. I'd very much want to hear not only from the ranking member, but everyone else about their ideas on what should be the topics of future hearings. So far, I've seen a need for us to hold a future hearing on LIBOR and legacy LIBOR, to hold a future hearing on bond rating agencies, also known as credit rating agencies. And after this hearing, it's very clear to me that we need to bring in some accounting professors and then hear again from the FASB. With that, pursuant to a prior understanding, I will recognize the ranking member for a 1-minute closing statement to then finish with a 1-minute closing statement of myself.
Thanks, Mr. Chairman. Chairman Duhnke, thank you for showing up at our CECL hearing, CECL overview today. I do want to follow through on some of my concerns that I had expressed about some of the redundancies, the overlap, the efficiencies. This is a time when many are concerned about deficits and spending that we look the American taxpayer in the eye and tell them we're giving them the best value that they can possibly get out of their hard-earned dollars. Mr. Golden, appreciate you being here. I know it is clear to you that there is broad bipartisan concern about the direction, the timing, as I had indicated in my opening, with the Treasury and knowing with the Treasury report that is being worked on, and I know the efforts of my friend and colleague from Missouri to get that study and that put into the FSGG appropriations. It is something that many of us believe should and certainly must, in my opinion, have valuable information not only for us, but for you with what is transpiring here. So I know my time's up. I appreciate this, and I look forward to future hearings.
The FASB has a bigger impact on Americans' lives than any other entity I can name that they can't name and do not know about. It exercises governmental power and needs oversight. As to CECL, all of the supposed benefits could be obtained by simply providing supplemental disclosures in footnotes. That provides all the transparency. That gives the analysts all the information they could possibly want, and if they want more, we could give them another footnote. The decision to instead affect the basic financial statements poses a grave danger to our whole concept of accounting, since it moves us down the road of saying we must predict and pre-recognize all imaginable or future bad events. That isn't historic, that isn't reporting verifiable history, that's doing the analyst jobs for them and predicting the future. And finally, research and development. It's obviously bad accounting. It cannot be defended. It wasn't used for 100 years, and it hurts our competitiveness around the world and is responsible for us not getting a lot of the research results we need. With that, I believe the hearing is over. Thank you. Oh, before we adjourn, I've got... Today, all members will have 5 legislative days with which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I thank our witnesses and ask them to please respond promptly. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. This hearing is now adjourned.